I think the interesting point is from an investment manager's perspective, there is a very profitable asset pool out there which one can tap into. Good. So now I won't have to rely on my old and failing memory, and I'll probably do a little better job now. Okay. Good. So I guess something of what I already spoke about is that, sorry, let me just try to, let me go in any case. Go. Growing twice the rate, I mentioned that this is one of the largest growth opportunities and should grow fairly strong going forward. Okay?
Full screen.
Yes, sir. Thank you so much. Didn't seem to happen. Thank you so much. Thank you. Good. Sorry about all of this. So with that, these are some numbers. Of course, there are different scenarios given out there. The source of some of this literature is PwC and the others is Tower Watson. But importantly, of course, there are different scenarios given out there. And in terms of the growth of the asset size from about $7.9 billion today, which is mentioned out there, it could be depending upon the outlook for, whether you have a benign monetary policy or you have a more, let us say, you have it's more accommodative or it's more restrictive. And depending upon the global economy, the growth can vary between 8 to 10%, and the asset size can be 13.6 to about 15 billion. I think the absolute numbers are not important. What is more important is the fact that there is a significant opportunity out there, and there's a significant amount of space which can be captured. Madon showed this in a different cut. I'll just show it differently. Like I said, real estate is among the larger asset classes out there, followed by hedge funds, and they account for more than 50% of your overall market. Private equity, another about 25%. And I think the slide or the section below is important, because when you look at the market today in India, it's essentially an HNI market. So you rely on HNIs. There's very little in terms of institutional participation at this point in time. But for various reasons, and I'll attempt to touch upon this going forward, we believe that that can become, this along with another regulatory change which has happened very recently, can account for a very, very significant inflow of institutional money into AIFs, which could give it another very big leg up. And I'll come to that in a few slides from now. Okay? What this says is simply the following, and I'll leave it at that, pension funds and sovereign funds are likely to be, are expected to be the largest investors as they are. They expect it to continue. In fact, a notable point which is made recently, that the world's largest pension fund, which is the Japanese Employees Pension Fund, has for the first time allocated close to 5% of its assets in alternatives, which obviously is a lot of money. And I think there are a few trends like this which would suggest that while pensions and sovereigns have participated, that participation should continue to go up globally, right? Like we said, nascent or nothing here at this point in time, but hopefully we will get a lot more. Again, this sort of the next two slides summarizes really what we're trying to say. And effectively, I think the points which are being made as follows is that a lot more funding, especially given what's happening to banking sector globally, it will rely on alternative assets, especially for anything in the space of infrastructure, in the space of build out assets. A lot of that would come from possibly from the alternate investment space, given what banking, the challenges banking has. As a lot of the developed world ages, there would possibly a lot more focus on alternate assets. And in terms of people looking for delivery of a degree of absolute return with an element of capital preservation becomes that much more important at this point in time compared to almost any point in time in the future, right? So these of course are trends which are happening globally. I also mentioned about more institutional investment, especially from sovereign investors, which are mentioned out there. Good. So that's that. The last thing which is also mentioned here, which I'll leave with you, is that it is believed that with the rise of let us say or the rich in developing economies, you will get a lot more participation from HNIs, primarily coming out of the more developing economies. So these were some of the key trends which were happening globally. I think important to say is just the following, is that high growth area, it's grown in the past faster than conventional assets, would likely going forward as per projections of various bodies continue to grow faster. You would get significant participation from institutional investors, which you have globally already, and that would continue. And importantly, which is not mentioned here, but it's something we had touched upon in the previous years, and this is very, very important, is that from an investment manager's perspective and also from our partner's perspective, is that the profit pools potentially for a lot of us out here are potentially higher compared to what you have in the more, let us say, conventional assets, which is a shrinking profit pool in terms of, or at least a profit pool, which is not growing just as fast. So good. With that, I think I've said pretty much what I need to, or key takeaways from the global space. I'll come to what's happening locally. Nothing more on this slide other than to say something which I think most of us here out here know, and it says that India, there is far more confidence in terms of this, far more global investor confidence than you have it in most of the markets. And it's something we know, but that's just putting it out there. What that means to investment is obviously that people are more open, more willing to consider, let us say, investments, different asset classes have more investable surpluses and are more willing to try something new. Good. So now, just a bit of, this is more background setting before we talk about what's happened. When you look at the Indian economy, of course, we are all very positive of what would happen going forward. But let's look at a bit about the conventional asset classes. Now you have a situation where, let us say, while equity, that's the public equities, after having a splendid run, has had a, let's say, a little more of a moderated last 1 year, wherein, depending upon which index you look at, but the Nifty and so on are flattish over a 1 year period. If you really look at it, small caps, mid caps a little more than that, but returns are more modest than what would have happened in the year 14, 15. Right? So that's something, that's one key trend. Two is that when you're actually looking at returns on fixed income now, if you look at basically a sovereign paper, and depending upon which point in time you see it in the recent part, or at what at what maturity you are, you're not getting anything more than 7.5 to 8% at the outset. And you're looking at investment grade credit, you are looking at maybe 825, 850. Effectively post fees, that means a rather modest return to investors, or a more modest return to investors post fees and post tax. You're talking on fixed income now, nothing more than 5%, right? I know there's tax-free bonds, a lot of which is coming in, but if you keep that out, you're talking on a post-tax basis, something like maybe 5-ish%, maybe 6-ish% on the outside, on let's put it, conventional debt. Equity, of course, is, long-term we are positive, but I don't think anyone's talking about a runaway market of the nature we saw in 2000, let us say, from May of 2014 to 15, right? For that about 1 year period. I think we're talking about more modest returns. There's clearly a case for anyone who can generate an element of absolute returns, anyone who can deliver some amount of alpha. There's clearly a case for investment managers such as themselves, right? So let's take stock and let's look at our report card after a 3 year period. When I say our, as in the industry report card over a 3 year period. So 3 years after the regulations were passed, which was somewhere towards the middle of 2012, what do we have? So we've had about 158 funds out there. It's actually funds, not asset managers, which is out there. And in terms of commitments raised, it's about 25,000 crores. The actual investments is lower, and that's something we'll come to. So it's, when you look at it from that perspective, it's a pretty good number. So you had a fair amount of participation. When you look at, and I don't have that slide out here, but when you look at the participation in terms of different asset classes, you've got everything from real estate to hedge funds to, within the hedge fund category too, you've got players playing different strategies. You've had film funds, you've had infrastructure funds, you've had, you can think of a lot, and it's probably someone's already done it or in the process of doing it. So I would put it from that perspective, it's a fairly good start. When you look at it, that's a fair amount of money, which is, I would say, profitable money because when you break up an asset manager's money too, you look at what is liquid or near liquid money, which makes you not too much money, and then the more profitable assets. This is fairly profitable assets for most of us, so it's a pretty good amount which we could look at. There's a fair amount of spread out there. Category 1 and 2 obviously dominate. Category 3 has been a little more modest, and there are some very good reasons for that, though Category 3 should come into its own in the next some time. I think the regulations have been quite phenomenal. I mean, when you look at the regulatory framework, I think the regulators have put in, I think, extremely good regulations, which really make it, if I was to put it, you give a lot of opportunity for players to participate. You get a very wide spectrum, and I think there's not too many people who can complain that they are constricted, other than maybe something on the Category 3, which is actually less of a regulatory thing and possibly more of a tax issue rather than a regulatory issue. Okay. So far, I think the other very, very interesting thing is that you've had a lot of players. You've got large players, so you've had most of the large asset managers there too, and you've also had a lot of small and niche players. So that's really great. It's not just dominated by a few large players. It's fragmented. You've got a lot of small players. There are many, unlike, let us say, the mutual fund industry, which is the other large investment management industry, which is monolithic. There are just a few strategies which you can do broadly, right? There are so many different categories, there's scope for everybody, there are a lot of niche players, a lot of guys doing extremely strongly in the niche, so that's all wonderful. So 3 years later, you had a fair amount of asset managers, you had a fair stretch of products, you've got a fair amount of assets, at least commitment raised, most people doing reasonably well for themselves. So I think it's fair to say that so far this has been, in our view, rather successful. Okay, that's just a numerical perspective on it. We don't need to focus much on, the numbers are the same. It says commitment of 25,000 crores approximately. I think the important takeaways are the following, that you've gone from 0 to 25,000 crores in 3 years, pretty good by any standards. So, in the vicinity of, let's say about $4 billion, pretty good. Number 2 is that growth over the last 1 year, growth has been, again, it's nascency, but 85%. You've got it for different categories out there too, in terms of what has been the growth in category 1, 2, and 3. Category 2 has been the strongest. Another point I should mention, actually, I should have mentioned it in the context of the earlier slide, is that it's primarily been debt focused. When you look at the AIFs, it's primarily been debt focused, and there is a reason, of course, and I think that has to do with the taxation on the equity part, which is unfortunate, but that's the way it is. But debt dominates, so there's a lot more scope for equity-oriented strategies also coming into play with the appropriate framework. One of the key, so of course, the last point out there, category 3, unfortunately, for various reasons, hasn't really been able to grow, and that's, again, like I said, not on account of the participants, but maybe on the framework. Finally, and I think this is a very important point which I want to make here, is that when you look at the commitments raised and the deployments done, there is a vast difference. It's almost close to 50%, and that's sustained, which is, so you're getting commitments, but the deployment is running behind it. Now, that always happens. It has to happen. But I think the important point here is that the biggest challenge, or one of the larger challenges in this industry, to our mind, is the appropriate deployment of investors' money. It's, fundraising, and one of the comments I have made subsequently is that most people have done reasonably successfully on fundraising. There's almost no one who's really, in that sense, failed, right? Most people have done reasonably well there. But the key here, ladies and gentlemen, is how successful people have been on deployment, and, well, ultimately how successful will people be on returning that money to investors. But that's very important, because, see, bear in mind, in alternate assets, the bulk of it, other than maybe category 3, where you might do, let us call it exchange traded assets, etc., it's primarily unlisted. And in this country, everything other than maybe nifty stocks, your larger stocks, and government securities is illiquid. So your biggest challenge is deployment. Your biggest challenge will subsequently be delivering on that and giving. And that is something which we need to know, because that, to my mind, can significantly constrain the growth of the industry going forward. Okay. I think I've covered some of this. Debt funds dominating, most have done reasonably well. Couple of points which I will leave with you is the following, is that you actually started to see a trend, and I've only seen two cases, one of a more, one which I think people may be more familiar, where an investment manager with a particular strategy has actually tied up with a larger player with a larger brand and more distribution, right? Tied up, acquisition and so on. And you probably see that trend because, you may have, let's just assume for a minute that, this is a smart manager, I can run great strategies, but I don't have a brand, I don't have that sort of support, the infrastructure. Maybe I can tie up or my company be acquired or whatever mechanism with a larger player. You've seen that happen, and I suspect you'll see a lot more of this happen. Because, see, one of the beauties of the alternate management industry vis-a-vis the more developed, say, the mutual fund industry, is that you have a lot more smaller players, you have a lot more guys with niche strategies who can deliver very well on the respective strategy, maybe don't have the brand, maybe don't have the reach, which they can leverage off by tying up with a larger player. We've seen a couple of cases of that happen, and that's great, When I say that's great means it's good, it's a trend in the industry, and you'll see a lot more people doing it. One very, very important thing which I just want to leave with you, it starts with the point, and please look at it because this is really important, is the recent RBI regulations which say, or RBI guidelines which say, now offshore investors can invest directly into a domestic AIF. Okay? Now that effectively is really, really powerful. Because rather than coming through, and you can still come through an offshore route, say for some strategies, I'll give you an example, like real estate, where there are various constraints in terms of what assets an offshore investor can invest in, he can come directly into an AIF. He could do it for other categories too, not just for a real estate fund or category 2. He could do it in other categories. But that is a huge potential opportunity which is opened up. Very recently, it's less than a month old. This is something which, to our mind, we believe will be a very key driver going forward. Very, very key driver. And this, I think, is really, really important. Because, I mentioned that this is a primarily market dominated by domestic HNIs, right? I think this sort of a move can help change that. There are a couple of other moves which, again in the same lines, is that you've started to see insurance companies come into. There are certain restrictions as to which strategies they can come in, but you've started to see that. You've also started to, banks come in a smaller way, but I think that might be short-lived. Insurance companies is probably more likely to be a longer-term player. And the last point which I'll leave out here, which in many ways is unrelated to which is apparently unrelated to the AIF industry, but is very, very key is this. And I know this because we are an investment manager. We are one of the managers to the EPFO, the government pension fund. And for the first time, they have permitted investment into equities, right? Now, I'm not sure how many people realize this, but this is really a very, very significant step. It's a very, very significant step. Not for the AIF industry, but for the industry in general, for public equities in general, and, for India as a country. If they can do it today, and they've been extremely progressive in their thinking, you might have a situation, and I'm using the words very carefully, you might have a situation, depending on how that experience goes, that 5 years later, you might have them considering something in the alternate asset space. And then think of the pools of money which are out there. There are huge, huge pools of money out there, and we are managers to two of the two largest pension funds in the country, the coal miners pension fund as well as the employees provident fund. And both of them, if at some stage start looking at this, just think of the pools of capital which could potentially be out there. So I'll leave you with that. That's some of the trends which have happened in the last 1 year. This talks about the regulation. I don't think we need to go. There are a lot of changes which have happened in the last 1 year, typically all for the better. But the most important point I would just leave with you, something which all of you know, is that I think the regulatory framework has really been an enabler. It's been very positive, and the regulators have been extremely positive on this. Generally, experience on that front has been that regulations are absolutely not hampering business, they're actually enhancing business, and which is really great. At the same time, I think taking care of the investors, because that's very, very important. Good. Just concluding, a few slides which I just want to talk about is that, so far I think everyone's done rather well for themselves in the last some time, or at least reasonably well for themselves in this last some time. Well, what's really determined let us say, the degree of success. Good performance, of course, it's been, typically 2 or 3 years, so there's not much you can talk of in terms of performance. Of course, some come with a longer history. They may have performed on different platforms and they're sort of porting it here, but for those with good performance, that's obviously counted. Where you have a strong brand perception, that's really played out. For example, we know at least some players in the category 2 space who really no expertise but a strong brand, and they manage to raise money within that respective strategy. Third is, of course, some guys, and more so in category 3 space, in AIF category 3, have some really differentiated strategies and done very well, and those people are rattling good amounts of money, especially in a flat equity market over the last 1 year. So some guys doing very well, some guys leveraging their parent strength. So some guys, typically you have some AIFs which are sponsored by NBFCs, they get a lot of support for their NBFC and are being reasonably successful. So, pretty much what might be obvious, anyone with a strong brand has at least got a reasonable start. Not anyone, some of the people with a strong brand have got a reasonable start. Investment performance obviously is a key driver of sales, and a differentiated strategy for some of those players has really helped. So that's gone. That's really what we've seen. I don't want to take names because I think that's inappropriate in a public forum, but we probably know what I'm talking about. Okay, challenges and way ahead. Simple. Some of it we've covered. I think one of it is clearly deployment and execution, because it's all very well to raise the money and you'll get money, but what you do with that money, what you deliver in it, and how you return that money over a period of the length of your strategy is absolutely key, and that will determine how the individual manager grows, how the industry grows. This absolutely, to my mind, is the key. Deployment, because there's no point in getting a commitment which you can't appropriately deploy. That's number one. And we've seen that in a lot of cases. We've seen investment managers got a big commitment, unable to deploy money even after 2 years, 3 years, and that's a big challenge. That ties in with the skill set. There's not too much of, or at least a track record for some of the strategies which you have. Most of these strategies are relatively new, not too much of a strategy, so it's a bit of a brave call maybe for the investment manager, as well as in points in as well as for the investor too, because you're really buying more of a concept and how it will deliver, rather than something with an established track record of 10 years, 12 years, etc. Right? I think one thing which is my pet peeve when I want to talk about is that I think most managers are not focused on profitability. Sometimes I wonder why guys sell their product at a certain pricing. Really, after the fee you charge distributors, I'm speaking from an investment manager's perspective, okay? After what you charge and what you pay to your distribution partners, etc., I've not seen too much money being made by a lot of investment managers. And, that's a pity, because competing on price, to my mind, is not the way this industry should go. It should not be going and competing on price. It should be going and competing on delivery. It should be going and competing on strategy. It should be competing on, alpha, on those sort of things. I'm not saying price is not a factor. Price is, of course, a factor. But, if you're doing a good job, you want to earn something for it, right? And because that's the only way you will continue to retain good talent, and you will continue to reward that talent, and you would, and if you're good, you need to earn for that, right? So that's something which is extremely unfortunate, because most guys say that, just sell cheaper is a great way to go, but I hope that sorts itself out. Unfortunately, that's not the way the industry has in the past behaved, so let's see how that goes. Okay, I think most other points are covered. There's not too much of a track record of performance. There's very little of a track record of risks too, because people may be running strategies. Risks of that strategy will be fully tested as time elapses. So that's something which needs to evolve, which all of us need to know. There have been some very, very basic things which might actually seem quite innocuous, but have actually got a fair impact. Is that all of you guys know that you've changed the methodology, rather, from you had tax deducted at, let's say, prior to till March 2015, tax was deducted at the AIF fund, and then it became passed through. Now, when you are raising money during that period, try reconciling your books and try addressing investors' concerns from a perspective of operational perspective. It's quite a mess. right? So you've got various things out there which need to get sorted out. There's small niggling things, I'm sure they will get sorted out. The bigger ones I told you, I think it's appropriate deployment and let's put it this way, appropriate pricing of one's product and very, very important. Most important is, appropriately communicating with your investor audience, appropriately telling them what your product is, them appreciating it, because the biggest challenge for an investment manager, to my mind, is expectation management. It's not delivery of the actual investment management return, it's expectation management. And in this sort of an industry, it's all the more challenging. Good. I think I've pretty much concluded whatever I need to say. Some nice things which I'm going to say out there is because if we deliver value to our investors, I think we can justify, all of us can justify a great place. Distinguished strategies will do well. Finally, in conclusion, I think we've all, the industry's made a very, very promising start. A lot of new concepts have come about, have been approved, and have come into fruition. We need to see, but however, we need to do a lot in place. One is, of course, investor education, investor management, delivering on our, let us say, stated investment mandate, investment objective, developing skill set, improving your investor experience, and so on. Finally, the last statement which I would make is the following, is that I believe that with a couple of those changes which have come about this year, which is, one is, of course, that offshore money can come into an AIF, point one. And point two is, by potentially having more institutional participation, locally it can come only from insurance companies in a meaningful way. Initially, I can't see it coming from elsewhere. I think could lead to a lot more expansion of this market just from an HNI market to a more, to a far wider audience. Not that HNIs is bad, but you just want a wider audience of investors to cater to. Good. So with that, I think we've had a great start to an industry, and if all of us continue to do the good job we have been doing in the past, I think we would continue to have a great future going ahead. So it's for us to take, it's for us to grab, and that's all I have to say. I would just like to, we've probably got 5 minutes more, so if there are any questions, I could just address maybe 3 or 4 of them. Sorry, okay, this guy and then, yes please. Yeah, please.
With the advent of NRIs acquiring, holding and selling in AIF, what is the impact of FATCA in IAF? Because in the traditional investment space where I come from as a financial planner,
right,
especially there are a lot of potential investors coming from US and Canada.
Right.
With the advent of FATCA,
right,
people are being put off, or maybe the companies don't find it's worthwhile in terms of compliance costs to encourage investments from US and Canada customers.
Okay.
Where does the investment manager look at AIF from the FATCA point of view? Does it have an impact in terms of sourcing the funds from a potential investor from US and Canada?
Okay, so I must plead ignorance from a following perspective that, while I look after the business, I'm more on the investment side and so on. Our team, I believe, because I come from one of the largest investment managers, Reliance Capital Asset Management, we believe we have it addressed, and we are addressing it in different ways. What specific measures we're doing and tasks we're doing, one, I don't know, and I can't, probably we could do this offline. I can put you in touch with my colleagues who will be able to guide you. But we have put in place our, let us call it process flow, investment flow for attracting money from overseas investments, including some of the jurisdictions which you mentioned. So we can discuss this offline. I'd be happy to help. Okay.
Normally we understand.
Right.
Internationally, as you put the figures in, most of the monies have come from institutional investors into this space.
Correct.
So what are the biggest impediments in India? Why institutional investors are not coming into this space?
Sure.
And that can really endorse my feeling is that they are not very confident about this industry and people who run this at this point of time. Is that so, or is there any other impediment?
Okay. It's more to do with the regulatory framework. Getting into, because here I'm not here to speak on different industry regulations. Example, like pension funds can't invest. Very clearly, they can't. I'm not saying that they wish to also. Whether they wish to or no is a separate story. They can't invest today. right, with the current regulatory framework. Insurance companies can invest in certain categories of AIF, cannot invest in certain categories. That too opened up recently, again, some time back. So banks, today, well, banks can invest. They, of course, have their own constraints in terms of capital and so on, which is the bane of the banking sector in India and worldwide too. So when you're looking at institutional, I mean, if you're looking at, and we don't have too much in terms of sovereign investors here, right? I mean, as in a domestic sovereign investor. So really, what are you talking about? It's more a regulatory issue. I don't think it is, you know, when you look at it from an perspective of an institutional investor, you know, the sort of money which we're talking about 25,000 crores, of which about 10,000, 12,000 crores is what has been actually drawn down. When you look at it from most of the pools of money available in that category, it's piffling. It's honestly nothing, right? So I don't think, sir, that in my view at least, it's more a regulatory issue and not a confidence issue.
You have access to the cat sheet.
Right.
How do they compare with the equity mutual fund?
I guess for that, sir, I mean, you know, you need to speak to each of the individual managers. I may have something, but that would be more on a you know, sort of, I may just have got access to it, but, you know, in many ways, I won't have any systematic or organized knowledge. But I'm sure they will provide it to you. They want to sell the products. Yeah. Good. Yep. Sorry, sir.
Hi, how are you? Thank you for the presentation. You talked about managers that set themselves apart as ones that deliver alpha. And I'm wondering if a first generation of benefits could talk about the alternative sources of beta as a get-go. Because I think when the average investor thinks about alpha, they're thinking about outperformance against a broad index versus gambling down the volatility of the portfolio. So I wonder how you think about just the access to cheap beta, which is a huge risk gambler, versus absolute alpha, which I don't know if that's necessarily what the next generation is looking for into the portfolio.
Okay. So your question is that if do I have any thoughts in?
Well, you had said that what sets a manager apart is
Right.
delivering alpha. And
That's
I
right.
would challenge that a little bit to say, I think one of the solutions around alternatives is more uncorrelated beta in the portfolio as
Right.
opposed to just
Right.
pure alpha.
Right.
I'm curious if you have any thoughts on that.
Honestly, I can't throw too much light on that at this point in time, so I'll give it a pass. Yeah? Good. I think the last question, and then we can conclude. We shouldn't delay the next speaker. Yes, sir.
The size of our alternative investment assets in India, especially. I mean, like you said, it's just 25,000 crores right now, and people are unable to deploy funds even after raising funds, right? So, is that a fair understanding, or is that a chicken and egg?
See, maybe it's chicken and egg, but you know, my first point is the regulator doesn't even permit you to get there. So, you know, that may be a second consideration of a large investor saying, boss, it makes no sense for me if I have 200,000 crores. But that would be the second step. At this point in time, they can't even contemplate in some categories because the regulations don't permit them to do. But that might be a consideration at some stage. Good. I think I should conclude because that would be otherwise be disrespectful to the next set of guys, right? So, thank you so much. I hope that was useful. And, you know, if there's anything, I'm always happy to be in touch with any of you in any forum via email or anything. And I'm sure the presentation, if required, can be made available by Aditya. Yeah? Thank you so much.